Hi, welcome, welcome everyone. This is another session for the strategic case study, and I'm excited to be here. Today we'll be talking about strategic models. We'll be doing a part 2 of it. And if you haven't watched the previous videos, they are all on the channel. Please do so. Please do so. And subscribe to the channel, please. So I just wanted to let you know that all these video lectures are on our YouTube channel. It's all for free, So this is our YouTube channel. Just wanted you to know, this is our YouTube channel. This is how it looks like. And, you see these thumbnails here, and you see the subscribe button and the notification bell. I'm hovering my cursor over it. So click the subscribe button and also click the notification bell as well, so that anytime we post a video, you'll be the first to get it. It's like I'm doing all these lectures for you guys so that you guys can be able to pass your exam with ease. Very, very important. And I'm happy to serve you guys. I'm happy to help, and I'm happy to make sure that you pass your exam and you see success. Then we also have our social media handles, right? These are our social media handles. So this is our Facebook. This is how it looks like. This is our Instagram. This is how it looks like. So Pinnacle Professional College. If you search for it on Facebook, Instagram, you definitely find it. So let's move into today's objectives. Today we'll be talking about internal analysis. Then we'll talk about the elements of strategic management and business analysis. If we have some time, we'll talk about ethical issues. Then we'll also mention, we'll give some recommendations, but we'll be focusing more on strategic models. To be very honest, we'll be focusing more on strategic models. So let's zone into that. Let's zone into that right away. So let's talk about critical success factors. What are they? What are critical success factors? Critical success factors basically are factors that are essential to the success of a business entity. So it refers to those components of strategy in which the organization must excel. Those components of strategy in which the organization must excel to outperform its competition. Very, very key. Very, very key. So if you pick, let's say, the telecommunication industry or the banking industry, right? If one of the key critical success factors will be, let's say, extremely excellent customer service. If you want to outperform competition, you have to get that right. So critical success factors are factors that are essential to the strategic success of a business entity. Very, very important. Very, very important. So think about it. What are some of the things that are critical for an organization to succeed over its competitors? Those are critical success factors. Now, we can't talk about critical success factors without talking about KPIs and benchmarking. So when we talk about KPIs, or key performance indicators, they are measured targets for critical success factors, or what we call CSF. So these are measured targets. Very, very important. These are measured. These targets are measured. They are measured. Please remember that KPIs are measured targets for critical success factors. So what do we mean? In your critical success factors, you might define excellent customer service as a critical success factor. Now, you need to break that down into a measured target when it comes to your key performance indicator. So a typical example of a key performance indicator would be, something like something specific. It will be something specific. It will be something, well-defined. It will be something measurable. So it's very, very simple. It's very, very simple. Let me show you an example of how this works. So if you take a critical success factor of, let's say, convenience for the customer convenience, customer convenience, or ensuring customer convenience, a key performance indicator would be, if it's in a banking industry, if you want to make things convenient for the banking customers, would be like number of visits on your online platform or your website for transactions. So you want to count the number of online transactions, because the whole online thing gives customers convenience. They don't have to enter into the banking hall. So that's the key. That's the key here. The KPIs, or key performance indicators, are more measured. So if you mention something like customer convenience for critical success factor, a KPI for, let's say, a bank would be number of online transactions. Because when customers are doing stuff online, it gives them convenience. It's convenient because you don't have to walk into the banking hall to do a transaction. Then what is benchmarking? Benchmarking is simply comparing your own performance against the performance of someone else who is a standard, or someone whose performance is the best in the industry. Very, very key. So let's talk a lot more about benchmarking, because we need to understand this concept very, very well. So when we say benchmarking, we are referring to 4 types of benchmarking. Number 1 is internal benchmarking. Internal benchmarking is basically where you pick a function within the organization and compare it to another function or unit within the organization that is performing extremely well. So in internal benchmarking, everything is within. Everything is within. Very, very important. Very, very important. Everything is within. Everything is within. So, for example, you can pick if, let's say, the finance function or the finance unit is the best performing function, HR, can benchmark against finance. That is internal benchmarking, because it's within the organization. They have competitive benchmarking. Anytime you define benchmarking, this is what comes to mind: competitive benchmarking. Because here you are comparing your performance against, a successful competitor. Against a successful competitor. Very important. Compare your performance against a successful competitor. They also have customer benchmarking. Customer benchmarking. Usually, customers will have an expectation of what performance should be in terms of relating to the organization. So in customer benchmarking, organizations compare their actual performance in relation with their customers to what customers' expectations actually are. So you are comparing actual performance in relation to your customers versus customer expectations. So here we are assuming that customer expectations are the standard, and the organization is comparing its actual performance with it. Very key. They also have operational benchmarking, right? You also have operational benchmarking. Operational benchmarking is basically where an entity compares a particular operation, within its entity, right, with a similar operation in another business which is in a different industry. So let me take it again. In operational benchmarking, an entity compares the performance of a particular operation with the performance of a similar operation in a different business entity in a different industry. So this one, it's comparing operation to operation, but the operation could be in a different industry. So let's take an example. So if you pick, let's say, Microsoft and Apple, right? Microsoft and Apple. Okay, these two are in the same industry. So let's use another example. If you pick Microsoft and Goldman Sachs, which is a bank. If you pick Microsoft, which is a tech company, and Goldman Sachs, which is a bank, Microsoft can compare its IT operations with Goldman Sachs' IT operations. These are in different industries, but you can compare an operation within one with the other. what you are doing here, let me say it again, is in operational benchmarking, the companies don't have to be in the same industry. You can compare your operation with another one in a different industry. So I use the Microsoft and Goldman Sachs example. Microsoft is in the tech industry, Goldman Sachs is in banking. So they can compare their IT operations. Very, very important. Very, very important. So that's a bit about operational benchmarking. Always remember that in operational benchmarking, you can compare operations in different industries. So how is competitive benchmarking even done, right? How do you do it? You can do it first off by you study the published financial statements of competitors. You have to study it. You have to study the published financial statements of competitors. You also have to understand financial ratios. You need to analyze the financial ratios of your competitor to be able to understand their position financially. You also need to analyze their products when you are doing competitive benchmarking. That is benchmarking yourself against a competitor. You need to analyze products. You need to analyze product. Very, very key. You also need to talk to customers who have had dealings with the competitor you're comparing yourself to. It's very, very important because the customer can give you some feedback that is very critical. That will be very critical to the success of your organization. Now let's move on to, I said we'll be zoning into models. So let's move on into the models, right? Let's move on into the models. So here we are talking about the value chain. Please, this is a very important model. So please pay attention to this. Value chain. So when we say value, what do we mean? Value refers to the benefit that a customer obtains from a product or service. The benefits that a customer obtains from a product or a service. So value is defined by the attributes of the product. The attributes of the product. And value, as you know, might be real or perceived. There are a lot of people who buy things because of perception. Because they feel that this thing or this product delivers some value. So always remember this. Always remember this. The reason why I'm defining value is because we need that to understand the value chain. So keep that at the back of your mind. Value relates to what? The benefits that a customer obtains from a product. So if that's value, then what's the value chain? It's basically, when you hear chain, the word chain, it means processes. And we know that value means the benefits. So it is the processes that give the benefit to the customer. So what do I mean? It's basically the processes in the organization, right, that help deliver the benefits or the attributes of the product that the customer would, basically need or basically enjoy. Like I said, value means benefits and chain means processes. So it's basically a framework for analyzing how value can be added to a product or a service. But I like Johnson and School's definition. It says, these are activities within and around the organization which together create a product or a service. You see, the activities or processes within and around an organization which together create a product or a service that offers value. So that's it about the value chain. Now, let's zone into the value chain in terms of primary activities and support activities. Now we are diving into the model here. Very, very key. So when we talk about the value chain, right? The primary activities has 5 components. It has inbound logistics, operations, outbound logistics, marketing and sales, and service. And I'll break this down simply so that you can catch it easily. Now, when we talk about inbound logistics, just keep the word in mind, inbound. These are activities that are concerned with receiving. You are receiving and handling purchase materials. So all of the activities that are concerned with you, getting the raw materials into the organization. So in a manufacturing company, for example, the inbound logistics will include things like transportation from suppliers, warehouse, materials handling, materials receiving. Here you are receiving raw materials. Then you go to operations. In operations, you are converting the raw material into a product, into an item that customers will buy. You see the picture? So in inbound logistics, you have raw materials. In operations, you are converting the raw materials into a finished product. Then in outbound logistics, here you are concerned with the storage of the finished goods before sale. How you store and package the finished goods before sale, and how you even distribute and deliver the goods to customers. So two things here, storage of the finished goods as well as distribution and delivery. Outbound, you are taking it out. You are taking the product out. The product came in, you developed it, you processed it, now you are taking it out. Then you move on to marketing and sales. When we talk about marketing and sales, these are activities that inform customers about the product. These are activities that inform customers about the product or the service. So here you are talking about promotion, you are talking about making the product known. You are talking about making the product known. Very, very crucial. Very, very crucial. Very, very crucial. Then you have service or after sales service. There are some products when you buy, there are some after sales service. They'll say, oh, we'll offer you a 1-year warranty. That's an after sales service. So these are activities that occur after the point of sale. Activities that occur after the point of sale, such as installation. Sometimes when you buy a TV, the company will offer to install it for you. Warranties, repairs and maintenance, etc. So after sales service is also a primary activity, and it's also included in the value chain. So if you take notes, all these activities help to deliver value. So you see where it starts from, the inbound. Then you also have value chain support activities. So these are support activities that support the primary activities. They are very, very critical. You have procurement, technology development, human resource management, and corporate infrastructure. Very key. Very key. Very key. So these are activities. For example, if you take procurement talks about supply chain. So this is about buying the resources. When you are buying the resources, so at the inbound logistics stage, you have to buy the raw material. So when you are buying the resources, you need to identify a cheaper source of material. And so here your negotiation skills are important. And when I say cheaper source of material, I don't mean low quality, but you need to get a good price for what you're buying. And that's what procurement is all about. And then when we talk about technology development, these are activities related to development of technological systems such as IT systems. Today technology is changing business a lot, and so you need to have your technology development process intact. Then you have human resource management. You cannot do or deliver products and services to customers for them to be happy without your people. So you need activities concerned with recruiting the right people, training them, developing them, rewarding them, and basically motivating them to do more in the organization. Very key. Very key. Then you also have corporate infrastructure. Corporate infrastructure. When we talk about corporate infrastructure, here we are talking about, how the organization is set up. This relates to the organization structure. Corporate infrastructure. So it's the structure and its management systems, how the organization is set up. Is it set up in such a way that it's able to deliver products and services to customers easily? So, for instance, we know there are some companies where there are a lot of bureaucracies. That is the structure. And in such companies, things are slow. And if things are slow, it's definitely going to impact how services are delivered or products are delivered to the customer. Very, very important. So please remember that. So how do you add value? How do you add value? You can add value by, a lot of ways. Number one is convenience, making the product convenient for the customer. Number two is how you deliver. Do you deliver with speed? So for example, Amazon can deliver things to you in a day. You know, do you deliver with speed? That's all value. You're adding value. You can deliver value through the product features, through how you brand the product. All these things deliver value. So when we talk about the value chain concept, we are referring here to certain critical questions that the organization will be asking itself, like how is value added by us as an organization? Where have we failed to add value successfully? These are questions that organizations must ask. Has our competitors been more successful in adding value? And what can we learn? You know, is there anything we can learn? Does the entity have the core competencies? You know, core competencies in this part of the value chain to add value successfully. Do we have these core competencies to deliver value to the customer? These are questions, critical questions that you should be asking. Okay, so we can't talk about value without talking about customer relationship. Is the relationship with the customer that helps to deliver value. So one key tool that's important is customer relationship management. And in customer relationship management, we are talking about three important things. I call them A-R-E. We talk about customer acquisition, customer retention, and customer extension. Three phenomenal strategies when it comes to CRM. Customer acquisition, customer retention, customer extension. What do we mean by customer acquisition? It basically means, you know, acquiring a customer, getting a customer to buy from you. Now, when you get a customer to buy from you, you've logged them in. But that's not all. You have to retain them. You have to make sure that they keep on buying. They keep on buying from you, and they keep on, you know, working with you, and they keep on, you know, enjoying your products and services. That's what makes you money. Then after that, when the customer came in, they bought a particular product, you know, they bought a particular product. But what we need here is customer extension. What do we mean by extension? It means here you do cross-selling and upselling. What do we mean by that? So for example, cross-selling basically means that when you joined, let's say, for example, let's say you go to LG to buy electronic equipment, right? Electronic equipment. And you bought a TV first. In cross-selling, what LG seeks to do is that you bought a TV, so right now they'll want you to buy a fridge. That's cross-selling. They'll be able to sell you another product of theirs. Now, what's upselling? Upselling, let's say you bought a TV, right? And the TV is, let's say, a black and white TV, just an example, right? Or a low version of a smart TV. Now they want to upsell. They want to, if they bring out a very brand new TV, that is their latest model, they want to upsell you. They want you to buy, you know, that new model of their TV. Do you see how it works? So through that, they'll be able to generate a lot more revenue from you. So that's cross-selling and upselling, and that's customer extension. You are extending more of your product to them. So three critical principles: ARE, acquisition, retention, extension. They're very, very key. They also have benefits. Let's talk about the benefits of or relevance of CRM. So CRM helps to customer relationship management. I'll be saying CRM because that's easy to say. What are the benefits? It helps to find out more about the purchasing habits and preferences of customers, and also helps us to do what we call customer profiling. Once we understand the purchasing preferences or purchasing patterns of customers, we're able to profile customers based on their spending. And it also helps us to set up our organization or our mode of operations in such a way that we are able to deliver, you know, more value to the customer. We are able to relate to the customer much better. So CRM has 3 levels, right? CRM has 3 levels. Number 1 is analytics. Number 2 is operations. Number 3 is collaboration, AOC. So analytics here, this is very, very key. Analytics is huge. You are analyzing customer data for a purpose. Every analytics has a purpose. So here you want to understand, you know, something about the customer. So for example, you want to analyze their spend, you know, their average spend in a week. That's an example. And when you talk about operations, here you are basically supporting the sales and marketing and customer service processes. Very, very key. Very, very key. So a typical example would be the organization will contact, anytime the organization has a contact with the customer, it is logged into a database so that all employees in the organization will have a history of client interaction with the customer. So there are times when I don't know if you've realized, but you contact an organization and, the first time and the second time when you contact them, they're able to pull up your complaint and say, oh, on so and so date, you contacted us on this issue. Hope it's resolved. Hope everything is fine. So that's all about operations. You are supporting the customer service processes. You are supporting the sales processes. You are supporting the marketing processes. You also have collaboration, which is direct interaction with customers. It could be through email. It could be through phone inquiry. You are having direct interaction with your customers. Very, very key. Very, very key. Very, very key. So let's talk about resources and competencies. And then let's talk about resources and competencies. So when we say a resource is simply any process or skill that is controlled by the entity. Keyword is controlled. You don't have a resource if it's not controlled by you. So resources can be grouped into human resource, physical resource, intellectual resource, financial resource. All these are resources, and organizations really need resources to deliver value. That's the whole point. You need resources to deliver value. Then you also have competencies. There's a difference between resource and competencies. Competencies is more about the activities or processes in which an entity uses its resources. So the activities in which an entity uses its resources, that's all about competence. They are created by bringing resources together and using them effectively. So here under competence, these are the processes through which an organization uses its resources. So competencies are used to provide products or services which offer value to the customer. So when we talk about competence, these are the activities in which an organization uses its resources. So there are two kinds of competencies, and that's why I wanted to bring to your attention. We have threshold competence and core competence. In your strategic case study learning, you hear a lot about core competence, but there are two types: threshold and core, and threshold competence and core competence. So what do you mean by threshold competence? Threshold competence simply means activities, processes, and abilities that give an organization the capability to provide a product with features that are sufficient to meet customers' needs. So when we talk about threshold competence, you are talking about like a base or a minimum standard. So these are activities that help the organization to deliver products which have features that are sufficient to meet the customer's need. So here you are just doing okay with your product features. It's just the minimum expectation. So the key word is sufficient to meet customers' need. Sufficient to meet customers' need. Then you also have core competencies, right? These are activities and processes that give the entity the capability to deliver products with features that would help the organization to achieve competitive advantage. So here it's more than offering just sufficient product features. It's offering products that will help the organization to be able to achieve competitive advantage. So you need to basically, under core competence, you are given products, that have superior value. And this product that has superior value is what will help the organization to achieve competitive advantage. So that's the difference, right? One, you have the threshold competence. Basically, these are product features which are just sufficient to meet the customer's need. And the core competence, you have products that are more of superior value and help the organization to meet its critical success factor requirements as well as its competitive advantage ambitions. So these products help the organization to achieve competitive advantage. So I hope you get a difference. I hope you get a difference. And so that's where we bring this class to an end. Please subscribe to this channel if you already haven't, and click the notification bell. As I post more videos, you should be the first to get it. Thank you and God bless.